So I think the attraction of gold is its lack of correlation to other assets that typically included in a portfolio, and also the fact that it's a physical asset. We expect physical demand to pick up late in Q3 and into Q4 due to seasonality. That should be more supportive for prices going forward. There was generally a sense of, in recent months, a sense of catch-up of the more industrial precious metals, so silver, platinum, and palladium. And I think this coincided with a rebound in broader commodities as well.
So first of all, UBS recently raised its gold price target by the end of 2025 to $3,500 per ounce. And it's the same price also expected for 2026. So what is the underlying logic of this prediction?
So we actually remain bullish on gold. We think that prices can continue to make new highs in the coming quarters. Our expectation is that investors continue to diversify their portfolios, and gold will benefit from that diversification. In this environment where there's a lot of macro uncertainty, lingering geopolitical risks, the case for having gold as part of a diversified portfolio as a safe haven asset to hold remains very relevant for many investors.
So are there any chances that UBS will change this prediction this year, and what will affect your prediction? Like, have you taken the risk of delaying Fed's interest rate hikes and other factors?
So our view will largely hinge on kind of how the macro picture evolves from here. So the biggest risks to gold on the downside would be if we actually see a reacceleration in growth, and that triggers the Fed to shift to a more hawkish stance, and we start to consider rate hikes instead of rate cuts. On the flip side, the biggest, I think, upside risk to gold is if the growth data weakens significantly, and we're starting to anticipate kind of more aggressive easing from the Fed.
So the situation of the tariff has eased to some extent. Is the current market uncertainty increasing or decreasing?
Uncertainty certainly it remains high, and there's a lot of moving parts, be it in terms of tariff negotiations, geopolitical risks, and the implications of this on growth and inflation. I think that is driving investors to want to hold more diversified portfolios, and gold is one of the assets that looks attractive in this scenario.
So does it affect your prediction of the target price?
We look at gold as a macro asset. So our overall expectation on economic growth, on inflation, on yields affect the price expectations on gold. But also kind of combined with that would be the level of investor sentiment towards gold and positioning, whether investors already hold target allocations or whether there's still room for them to increase allocation.
I've noticed that you once pointed out that if the Federal Reserve restarts interest rate hikes due to inflation, gold will come under pressure. So currently, the stiffness of the US CPIC's expectations, has UBS adjusted the prediction of the Federal Reserve's policy?
Our US economists continue to expect Fed easing, but I think it's a different scenario if we're talking about higher inflation because of external factors, be it tariffs or perhaps higher oil prices, higher commodity prices, potentially because of geopolitical risks. And in that scenario, it's not necessarily a negative for gold. So if the market starts to be concerned about continued weakness in growth while at the same time upside pressure on inflation, then it actually, I think, could create a more positive scenario for gold.
So you have also mentioned in previous meetings that you emphasized that investors are still in the early stage of increasing gold holdings. However, under the squeeze of stock markets, especially the technological giants and cryptocurrencies. So how can we persuade investors to prioritize the allocation of gold?
So I think the attraction of gold is its lack of correlation to other assets that typically included in a portfolio, and also the fact that it's a physical asset. So in a scenario where investors want to diversify into real assets, gold you know is an attractive option. Our view is that it's one of the cleanest place in order to sort of diversify against an environment with high levels of uncertainty and geopolitical risks.
Okay, so in June this year, U.S. Treasury bond was over 500 billion US dollars. It had already matured and pushing up the refinancing demand. So the 10-year Treasury bond yield has reached over 4%. And how do you evaluate the impact of the maturity of U.S. Treasury bonds in June on the gold price? And will the high yield significantly suppress the gold price?
So it's really yield rather than bond maturity that matter for the gold price. So if it's a case where higher yields are driven by a strong growth environment, then um, that would be negative for gold, because that represents sort of higher costs of carry, and also if it's driven by strong growth, again, it diminishes the appeal of holding a safe haven asset like gold. If higher yields are driven by kind of concerns about the U.S. fiscal deficit or concerns about rising debt, then that again could be a scenario where gold actually rallies. And I think we saw a little bit of that back in April, when long end yields were rising, but gold was also quite strong and was reaching new highs.
Yeah, so let's go back to the price of the gold, and with gold currently trading about 3,300 USD dollars per ounce these days. So how do you assess the risk of pullback in the current gold price?
In the near term, I think the market has scope to continue consolidating. Physical markets are weak during this time. A lot of market participants are on summer holidays. So I think the market can consolidate further. But I think this should provide opportunities for investors to get in at better levels. And the fact that so far the pullbacks have been shallow and brief, I think reflects that there is still a lot of interest to buy into dips. I think consolidation continues in the near term, and then well, depending on how the uh, macro factors evolve in the coming months, but our expectation is that we see renewed interest towards the end of the year. We expect physical demand to pick up late in Q3 and into Q4 due to seasonality. So that should be more supportive for prices going forward.
So let's talk about the platinum. Recently, the platinum has performed well due to the industrial demand and supply constraints, and the market data shows that the price of spot platinum has risen by nearly 50% this year, since the beginning of this year, far outpacing the increase in spot gold and silver, seducing the trends of investors. Shifting from gold to platinum will continue.
So the rally in platinum, which started really in late May, in our view, was driven by increase in investor interest. I think the recent rally is a reflection that the investors have been positive on platinum for a while, and the emergence of a potential kind of compelling demand story via Chinese jewelry demand has triggered sort of positions to be put on. But I think it's important to keep an eye on the data going forward, whether the inflows into China continue to be strong. So platinum imports in the coming months will be important to track.
Okay, so let's talk about the silver price in June. The international spot silver price soared above 37 USD dollars per ounce, hitting a new high in nearly a decade. So, what do you see as the main drivers to silver's recently?
There was generally a sense of, in recent months, a sense of catch up of the more industrial precious metals, so silver, platinum, and palladium. And I think this coincided with a rebound in broader commodities as well. I think the attractive relative value to gold, given silver has been lagging the move in gold, was kind of one of the key triggers. And especially for thinner markets like silver and platinum, it doesn't really take a lot of volume to move the price